Good morning, ladies and gentlemen. Welcome to the webinar on the TP guide, which has been recently been released by the FTA and how it impacts the UAE businesses as the year end comes to a close on December 31st, 2023. I'm Kapil Bhatnagar and an associate partner with Dhruva Consultants, and I'm a speaker for the day today. Before we start, certain housekeeping rules. In case you face any technical difficulties during the webinar, please post your issue on the chat box and our IT team is going to reach out to you separately and will resolve that. The webinar, we've scheduled it for 40 minutes. Post that, we will have a Q&A session for 10 minutes. If you have any questions, type them out in the chat box and we'll try to answer as soon as we can and as many as we can. The webinar is being recorded and shall be shared subsequently with all the participants. So what has been the journey of transfer pricing in the UAE? We've seen the law being announced and there are a lot of recent developments. So how has the transfer pricing law evolved in the country? On December 9th, 2022, we saw the UACT law and the FAQs, the English version, being released by the FTA. Then there was a ministerial decision 97 of 2023, which was a very key decision, which laid out the thresholds for maintaining the transfer pricing documentation along with the transactions which require disclosure in the local file and the master files. Apart from that, the FTA also came up with many guides, and one of the significant ones was the UACT law explanatory guide, which laid out all the nuances and all the aspects of the UACT law, including transfer pricing. The UACT law became effective from 1st of June 2023, and last week on October 23rd, we got a comprehensive guide released by the FTA, which details out the specifics of how the transfer pricing law is going to be applied in the country for related party transactions. What are the key guides, or what are the key highlights of the guide which has been released by the FTA? The guide is a very comprehensive and a very detailed document. It has been prepared primarily on the sidelines and on the guides provided by the OECD guidelines of transfer pricing policies. It details out the intent and entire coverage of the law as to how arm's length principle needs to be applied in the country. A step-by-step approach for common transactions, routine transactions, and certain specific transactions has been provided in the guide. A very key aspect and something which all of us were eagerly waiting for in terms of benchmarking requirements and how to apply TP methods have been detailed out. We'll discuss those in greater detail as we get into this webinar. The key aspect from that particular section is to say that for conducting any benchmarking analysis, a detailed functional overview and analysis needs to be done. There are certain comparability adjustments which have been recommended by the FTA, which can be used when doing an arm's length principle testing. The compliance requirements on local file, master file, CBCR, and TP disclosure form have been detailed out. While there are still some open areas and there are certain exemptions being provided, but this guide provides a very methodical approach in terms of how a taxpayer needs to prepare and maintain these compliance documents, and whenever the FTA calls for them, needs to submit them. A very interesting section on specific transactions have been laid out. This brings out the perspective on certain complex transactions and provides guidance to the taxpayer as to how these complex transactions need to be adhered to the arm's length principle, a step-by-step approach in terms of how to determine the arm's length price, how to determine the function analysis, what to look out for, and what possibly to maintain as a backup documentation has been provided in this particular section. The FTA has also clarified that the transfer pricing audits will be conducted by the FTA in detail. They have provided certain mechanics. They have also provided certain areas where transfer pricing adjustments can be done either by the taxpayer or by the FTA. So what is new? We saw that during the year, we've seen a lot of papers and a lot of guides and ministerial decisions being issued by the FTA. So what is new in this guide? few things which immediately catch our eye are: one, the definition of control has been expanded. There are certain examples being provided in the guide which detail out of how a particular entity can exercise significant influence and control over another entity and become a related party. There are certain exceptions being provided to taxpayers, specifically with respect to master file, in terms of maintenance of such TP documentation. With respect to low value adding services, certain safe harbor percentages and markups have been prescribed, which will immediately reduce the compliance burden and benchmarking requirements for a lot of taxpayers. In terms of related parties and connected persons, as we all know, the relationship or the way to identify related parties resides on the four aspects: whether there is a relationship of kinship, of ownership, either there is a composition of board or control. The guide has cited certain examples and has detailed out in terms of how significant influence through these mechanics can also mean that a particular entity is exercising control over the other. In case there is a lender and has given a loan to another party, and that loan constitutes at least 50% of the total capital of the borrower, then the lender and the borrower will be held to be as related parties. In case of royalty agreements, a licensor or a licensee, in case the royalty payout is more than 50% of the licensee, then the licensor and the licensee would then become related parties. Similarly, in case there is a shareholder, while in terms of determination of related parties, a threshold of 50% ownership has been prescribed. But in case where a shareholder plays a key role in decision making, and despite the shareholding being less than 15%, then these two parties will be held to be related parties. So what is the takeaway? What is the impact on UAE businesses? It is very, very clear, and the FTA has made it also very specific in the guide that the first step for a trans pricing analysis is to identify your related parties and connected persons. In light of the new guidance available, it is requested that all taxpayers look at what all related parties are there in the system and start recording their transactions and start benchmarking them. It is very, very crucial for them in order to avoid any non-compliance. In terms of benchmarking requirements, a lot of guidance has been provided. It has been prescribed that in order to do a benchmarking analysis, preference shall be given to domestic comparables. In any case, if the taxpayer is not able to identify suitable domestic comparables, the taxpayer has the option to reach out and identify either regional comparables, the Middle East region, or foreign comparables. However, the taxpayer will be required to do certain adjustments to account for those geographic differences when doing a comparability analysis. In terms of the data range, it has been provided that a multiple year data will be required to benchmark the arm's length prices. Out of the 3-year data, at least 2-year data should be available for those comparables. The FTA is cognizant of the fact that businesses undergo a lot of cyclical variations. A single year may not be a true representation of the industry or the benchmarks or the comparability benchmarks which are available. And hence, they have provided this aspect to say, whenever there is a comparability analysis, a multiple year data needs to be accounted for. With lines with the OECD guidelines, an interquartile range is prescribed to be picked up whenever an arm's length price or an arm's length margin is determined. The taxpayer is free to pick up any data point within that interquartile range to determine the ALP. However, that ALP or that data point needs to be very, very close and aligned to the functional profile of the taxpayer as well as with the related party transaction which is being tested. In terms of periodicity, the guide has provided that a fresh benchmarking analysis for a transaction needs to be done once every 3 years. in case there are no changes in the contractual terms, payments, etc. of that particular related party transaction. Accordingly, if there are no changes, then a financial update needs to be done on an annual basis. It has also been prescribed that a transaction by transaction approach will be accepted and will be preferred over a combined approach. So taxpayers are requested to do benchmarking analysis by following a transaction by transaction approach and fall back upon a combined approach only in cases where these transactions are closely interlinked to each other or they corroborate the primary approach of a benchmarking analysis. The five TP methods which have been prescribed in the OECD guidelines have been prescribed along with a sixth method, the any other method, which the FTA has released in the past. Combination of methods is permissible. The taxpayer is free to use two methods, one or more methods to prescribe or benchmark an arm's length transaction. There is no order of preference of picking up a TP method. The taxpayer is free to pick up a method out of those six methods and justify the transactions and may not want to discuss any other methods which may not be suitable to justify the arm's length price. The FT also recognizes that when we do a comparative analysis of a related party transaction with an uncontrolled transactions, there could be certain differences. Hence, they have accounted for and they've provided that the taxpayer is free to do certain comparability adjustments in their transactions when they are doing this analysis. These could be working capital, these could be risk adjustments, these could be price adjustments. These could be adjustments account of geographic differences. And hence, in order to align an uncontrolled transaction and make it comparable with the related party transactions, such amount of comparability adjustments are permissible. The FTA has provided guidance also to say that when a taxpayer is looking for arm's length prices and doing a comparability analysis, comparables with extreme results, for example, a heavy loss making or a continuous loss making company cannot be selected as it is. The taxpayer will have to do some bit of due diligence, some bit of more in depth analysis as to say why the comparable is into losses and whether that comparable can be selected as a potential case in the data point or in the arm's length range. Enough guidance and a very detailed guidance has been provided on the application of how a taxpayer can use a qualitative and quantitative filters to do the arm's length testing. The entire aspect of benchmarking analysis, which has been released by the FTA, resides on the OECD guidelines and on the principles enunciated in those guidelines. The big highlight is, or the big aspect which emanates, is that the taxpayer, whenever doing an arm's length analysis, need to do a robust functional assets and risk analysis that really forms the bedrock of any arm's length transaction to be tested. In terms of transfer pricing documentation, while the Ministerial Decision 97 of 2023 laid out a lot of aspects and the guides released previously also detailed out, however, the guide specifically provides that the TP documentation needs to be maintained by the taxpayers on a contemporaneous basis, which means as and when the transactions are being entered into, it is expected that the taxpayers will maintain such TP documentation, will start updating them and start updating whatever backups which are available. One big relief which has been provided is on the master file. So as per the Ministerial Decision 97, a master file applicability was on the basis of threshold, and the threshold was prescribed as either the taxpayer or the tax group, which is being formed either on a consolidated level breaches a turnover of 200 million dirhams or more, or the taxpayer or the tax group is a part of a multinational enterprise with a consolidated turnover of 3.15 billion dirhams. There are no changes in those materiality thresholds. However, an exception has been provided to say that companies which are only UAE headquartered and are not present in any overseas jurisdictions, which means they do not have a foreign footprint and are pure local UAE groups. They are not required to maintain a master file. Now, this comes as a very big relief for a lot of local groups which do not have a global presence and are present locally, have operations, and it reduces significantly the compliance burden on such taxpayers. In terms of local file, the threshold requirements are similar to what has been prescribed for the master file. There are no changes or no exceptions which have been provided except for the transactions which were not allowed to be, which are not mandated to be disclosed in the local file as per the Ministerial Decision 97. But the guide provides a step-by-step approach of how a local file needs to be prepared, maintained, and documented, and what all mechanics need to go under that. In terms of the TP disclosure form, it has been clarified that the applicability of TP disclosure form will again be a threshold based disclosure. The threshold and the form is still not out. The FTA has clarified that it would be announced in due course. In the TP disclosure form, the nature of transactions, the value of transactions, and the TP method which the taxpayer has used to justify the arm's length price will required to be presented. In terms of the CBCR or country by country reporting and notification, which has always been there since 2020, it is again a threshold based filing requirement. It is applicable on UAE headquartered multinationals which have a consolidated turnover of 3.15 billion dirhams or more in the previous year, which means that any non-UAE headquartered groups or a foreign headquartered group need not prepare or maintain any CBCR requirements in the UAE, and that is an exception which has been provided to the taxpayers. What it really means that one, since the documents have to be maintained on a contemporaneous basis, the FTA has clarified that as soon as the FTA requests for those documents, the local file and the master file on the taxpayers on whom it is applicable, the taxpayer will only have 30 days to respond and submit those documents. Since these documents are pretty comprehensive and very detailed, it is requested that all taxpayers should start collating backup documentation with respect to the related party transactions which they are entering into, which are recurring, and should start collating those documents on a contemporaneous basis. Now, this is an interesting section which has been introduced or which has been detailed out in the TP guide, which is on certain specific transactions. The FTA has come up with many examples, many practical examples and guidance with respect to how a taxpayer can benchmark certain specific transactions with respect to financial transactions, which include treasury, cash pooling, intra-group loans, guarantees, etc. It has been detailed out that what ideally should be the preferred TP method which a taxpayer can use to benchmark or justify the arm's length price for these kind of transactions. Again, the FTA is very clear that this is just a guide and an indication and should not be looked as the preferred method which the FTA would really want the taxpayer to look for. However, the FTA has clarified and detailed out the factors which needs to be considered for benchmarking for such kind of transactions, whether it should be the credit rating, the tenure of the loan, the currency in which it's taking, whether it's secured, unsecured, what is the jurisdiction, many factors which would determine the interest rate for such financial transactions. And they have detailed out the steps for determining the ALP. In terms of intra-group services, and which is commonly seen amongst UAE businesses, is a particular entity provides headquarter activities or a lot of intra-group services or support services to its group companies or subsidiaries in the region. The FTA has, on the principles of the OECD guidelines and action plan 8 to 10, they have clarified that the taxpayers will need to determine the need benefit test for for receipt of such intragroup services, which would mean that the service recipient will have to demonstrate by way of documentation that it actually needed those services. The recipient will also have to demonstrate that by receipt of such services, it actually benefited from efficiencies, cost control, etc. And that is an onus on the taxpayer which has been levied as per the guide. One big relief which has been provided is that in case of low value adding services, and the FTA guide has provided definition of what constitutes low value add, a cost plus markup of 5% will be considered as safe harbor, which really means that if a service provider is rendering low value added services to its related parties and is applying a cost plus 5% markup, then the service provider or the service recipient need not benchmark this transaction separately, as the 5% markup would fall under the safe harbor provisions. Yes, the FTA can come back and challenge and look at the cost base which has been applied and the allocation keys which have been applied while arriving at this particular cross charge. So the taxpayers are expected to look out for ensuring that the cost allocations for common services across various subsidiaries are on reasonable basis, they are on certain accounting principles, are closer to the reality, and if a 5% markup is being levied, then it really comes under the safe harbor provisions. Intangibles have always been a very unique and complex transactions. Detailed guidance has been provided in terms of how to benchmark intangible transactions, transactions involving intangible rights, ownerships, royalties, technical know-hows, etc. It has been mentioned that the taxpayer will need to identify entities who are engaged in either development, enhancement, maintenance, protection, or employed or exploitation of the intangibles, and basis that the concept of a legal owner and a beneficial or an economic owner has been determined, which means that while determining an ALP, these aspects a taxpayer will have to focus in and ensure that the arm's length price is akin to the commercial realities. The FTA guide has provided that while benchmarking such intangibles, alternate TP methods and preferably, let's say, an other method could be used to benchmark such transactions. It could be market appraisals, it could be valuation reports by an independent valuer, and those could be accepted as a valid benchmark when you're looking or benchmarking the intangibles transactions. In terms of cost contribution arrangements, it has been specified that whenever many parties jointly come together and form a cost contribution arrangement or a CCA, then the roles and responsibilities of each of the parties of that CCA needs to be demarcated and documented. The taxpayers will have to calculate the value of each of the participants and the contribution they are bringing on the CCA. Also, the allocation keys in which the contributions will further be given to the recipients and the expected benefits need to be benchmarked, and detailed steps have been provided for such transactions. It is very common that businesses will undergo a lot of business restructurings. There could be acquisitions, there could be demergers, there could be slum sales, there could be asset sales, and hence it has been clarified that whenever such kind of business restructuring transactions happen, the taxpayer would be required to document the expected benefits out of these business restructurings. It would be prudent for the taxpayer to really come up with a backup documentation to say as to why such business restructuring is being conducted in the first place. It has been prescribed that the arm's length price for transactions which now come as a part of your related party schedule, which are added after the restructuring, all of those are benchmarked, and even the transactions which were prior to the restructuring, if the restructuring has happened mid-year, those need to be justified from an arm's length perspective. In case of a permanent establishment, it has been clarified that a PE will be treated as a separate and independent entity from its parent or its head office. The taxpayers will be requested to undergo a thorough FAR analysis to determine the functions being performed or the activities being performed by the PE, and suitable profits should be attributed to the PE with respect to those functions. Overall, these guidances which have been provided are in line with the OECD guidelines and primarily focus that the taxpayers need to do a thorough functional assets and risk analysis to determine the nature and the arms and price of such specific transactions. One big change or one big example which the FTA guide has provided is on intercompany balances. It has been clarified that in case there are long outstanding intercompany balances, which may include cash, your normal routine trade or service transactions, and they are long outstanding beyond a particular limit in terms of, let's say, 60 days. So a contractual arrangements may say a 60-day period for the payment of such outstandings, but the outstanding is, let's say, 90 or 120. The FTA has clarified that such long outstanding balances may be recharacterized as loans, and the parties may be required to charge an arm's length interest rate on such outstanding receivables and payables. Now, this is a very significant development and a note which has been issued in the TP guide. It is requested that all taxpayers should look at their year-end balances, which are there either on 31st of December 2023 as we step into that regime, and say whether those outstanding receivables and payables are in line with the industry practice. Would have given such preference or credit period to an unrelated party? If not, alignments need to be made with respect to such outstanding receivables and payables. And if not, then an arm's length interest should be provided for in the books of accounts. The guide on these specific transactions has provided a step-by-step approach for all the TP methods on these certain transactions, which will become a very good reference point for all taxpayers as they step into the compliance area. In terms of the transfer pricing audit, the FTA has clarified that the FTA has the powers to conduct transfer pricing audits and make necessary adjustments to ensure that the intercompany transactions are compliant with the arm's length principle. A very big relief to the taxpayers has also been provided, which says that the taxpayers are also free to make such transfer pricing adjustments in their books of accounts on 3 occasions. One, they could do such transfer pricing adjustments during the tax period. So let's say a tax year starts at 1st January 2024 for a taxpayer, and after a half-yearly review, the taxpayer realizes that the transactions from 1st January to 30th of June are not aligned with the arm's length price. Then the taxpayer, during the tax period itself, can make certain transfer pricing adjustments in their books of accounts by either raising a debit or a credit note, doing a true up of a true down of those transactions, and that kind of transfer pricing adjustment is permissible as per the FTA. The taxpayer can also do a similar kind of tax adjustment even after the tax period, which means in our example, if the tax period ends on 31st of December 2024 and at the review in the next quarter, the taxpayer realizes that the prices were not aligned, then they could do after the tax period, but before filing the tax return, which is going to be due on September 30th, 2025. The FTA has also clarified and provided a very welcome move to say that the taxpayer can also make a transfer pricing adjustments in their return and books of accounts even after filing the tax return. But there is a caveat to say that this adjustment after filing the tax return can only happen if it increases the profit of the taxpayer or the tax group. So, in case any transfer pricing adjustment which results in the decrease in the profit of the taxpayer is something which may not be permissible and which may not be allowed by the FTA. But in case it increases the taxable profit of the taxpayer, those kind of adjustments have been prescribed and allowed by the FTA. The burden of proof resides on the taxpayer, which means that the taxpayer will be requested to maintain adequate backup documentation, calculation sheets of how these adjustments have been made, on what reasons were there, has the other party accepted such transfer pricing adjustments or not. So all those documentation is something which would need to be maintained by the taxpayers. The FTA, by way of a transfer pricing audit, has the powers to adjust the transfer prices if they believe that they are not aligned with the arm's length principle. They can also disregard a transaction in toto, and they may replace the transaction with any other alternate transaction to say, this transaction we believe is not arm's length. Leave aside the price, and this is something we are recharacterizing or rechanging the entire transaction to determine the arm's length principle. What it really means for UAE businesses, that the transfer pricing law, as it evolves and as taxpayers move into the tax period, on a quarterly basis or on a periodic basis, it is requested that all taxpayers should review their transactions, which they are entering on a day-to-day basis with their related parties, make suitable adjustments, while enough flexibility has been provided to the taxpayers to make adjustments even after the tax period. But then challenges from an accounting standpoint would come into play because the tax year or the accounting year would have changed. And hence, it is requested that during the tax period itself, a periodic review of the transfer prices is conducted by the taxpayers so that any transfer pricing adjustments, if any, can be done during the tax period itself. As a best practice, it is recommended that even before the taxpayers enter into the tax period of 1st January 2024, a transfer pricing analysis is conducted now so that the prices for all the transactions which are going to happen in 2024 are set today, and which would mean that minimal adjustments in the tax period on account of transfer pricing would need to be done. There are certain important clarifications which are still awaited. Guidance on how benchmarking of transactions with remuneration to KMPs is something which has not been detailed out in the guide, and we would like to hear more from the FTA on this particular aspect. Another key point is on the transitional rules. In the regulations, in the law, it has been provided that all year-end balances need to adhere to the arm's length principle as and when the taxpayers move into the tax period. Guidance is still awaited as to how these transitional rules from a transfer pricing perspective would pan out. The thresholds and the format of the TP disclosure form is awaited, while the FTA has clarified that it would be announced on the website in due course. But we would eagerly love to hear what would be the thresholds and the format of the TP disclosure form. Specific penalty provisions for non-maintenance of TP provisions is awaited. Whether it would be on justification non-maintenance of TP reports, whether how the penalty provisions will pan out is something which is awaited. Two key aspects which again we would want the FTA to clarify is one, what evidence taxpayers need to maintain to justify ALP in case a transfer pricing documentation applicability is not there. So on taxpayers where the threshold requirements are not met and TP report or a master file because of the new exception which has been announced is there. But then what would be the evidence that taxpayers from a documentation perspective need to maintain to justify the arm's length price. Similarly, for tax grouping, when taxpayers with a shareholding of more than 95% or more form a tax group, transfer pricing provisions dilute, and hence the requirements from on a tax group from a TP perspective go down significantly. Even in those cases, what should be the documentation taxpayers should maintain in order to justify the arm's length price? So, what should the UAE businesses do? As we step into the tax year, for many taxpayers, tax year has already started, whether it is July, whether it is September, whether it is October. But then, majority of the taxpayers in the region follow a January to December tax year. And for them, even for taxpayers for whom tax periods have started, what do we need to do given this new guidance which has been released? They should undertake a transfer pricing impact assessment exercise, which would mean that the first step should be to identify related parties and connected person. It is very, very important that taxpayers do not leave out any related party, because the penalty provisions would come not only for misreporting either in the TP disclosure form or in the transfer pricing report. And hence, if any transaction from a related party or connected person is left out, that could have significant penal consequences. Once we've identified related parties and connected persons, the next step should be to identify control transactions and undertake a detailed FAR. Like I said earlier, the FAR analysis forms a bedrock of the entire analysis of determination of arm's length price. The taxpayers should invest that time to determine which entity is performing what functions, basis which what should be the characterization and what should be the remuneration or the arm's length price for that particular transaction. It is very, very important that the taxpayers should start that analysis right now. And then once these two steps are done, then for the transactions, for the control transactions, basis the guidance, basis the 5 methods of OECD and the 6th method of the other method, and a combination of methods, they should take a comparability analysis. Care should be taken to focus on domestic comparables first, move to the regional comparables or to the foreign comparables later if the domestic comparables are not available. Once we've determined the arm's length price, the compensation of the parties needs to be aligned, which means systems needs to be updated, which means that proper profits should be recorded in the books of accounts in the supply chain for related parties. And if at all there are any adjustments which need to be made on account of transfer pricing, those adjustments, like we discussed, during the tax period or after the tax period before filing the return, should be made by the taxpayers to align all the related party transactions with the arm's length price. They should then also ensure that all appropriate reportings are done in the financial statements, because we've identified the related parties, we've found out the function analysis, we've done the arm's length margin, we've made the economic adjustments, we've made transfer pricing adjustments, and all these changes needs to be recorded in the financial statements appropriately. Your financial statements on 31st of December 2023, as well as for the tax period, and even during the during the year, should reflect your clear arm's length priced transactions. The big one, the related party balances as on 31st of December 2023 or whenever your year end is there, needs to be relooked at. The guide is very clear that long outstanding receivables and payables will need to be charged with an arm's length interest rate, and hence a realignment of such balances needs to be made. And if a realignment cannot happen, then provisionings for such arm's length interest needs to be factored in. Last but not the least, maintain robust documentation. Maintaining a backup documentation is very, very important. Our experience has been that all these aspects which we have discussed are already there in the system for taxpayers and companies. It is all about collating those agreements, invoices, debit notes, computations. It may be in some emails, it could be in some servers. It is very, very important that robust documentation is completed, is maintained on a contemporaneous basis, so that whenever the FTA comes for an audit, apart from the local file and the master file, which a taxpayer maintains, the backup documentation is also shared with the FTA to say as to why we believe the transactions were at arm's length and what were the underlying contractual arrangements which led to such transactions being entered into. Thank you. And now we'll take certain questions which have been posted by the taxpayers. So one, and we've heard it a lot, is to say, how do you determine the arm's length payment to connected persons? It is a very, a tricky aspect. Obviously, as a consultant or as a taxpayer, you cannot, how will you justify the skill set of a CEO who brings on the table? Now, a CEO would have, let's say, 20 plus years of experience, would have, different, salaries, etc. A CEO of a company A cannot be compared with a CEO of company B because two individuals, present different skill sets. There is enough guidance available globally. There are third party websites in the region which detail out the salaries or payments being made to such connected persons, the KMPs which are there. That is one. If that transaction by transaction approach of looking at these third party rates is something which is not practical, then can this KMP payment be clubbed with a main transaction and form a combined transfer pricing approach? So there are ways to justify it. There is a lot of buzz in, within the taxpayers that this is a transaction which is not easy to justify. Yes, it is not easy to justify, but it is not impossible. It is something which is practically available. Enough guidance is available globally to underline this. So another question which has been posted is, what do you mean by the sixth method? What benchmark do you do for a sixth method? So the sixth method is the any other method which has been prescribed. Now, it is a very big relief for the taxpayers to use the sixth method to justify the arm's length price. A classic example could be that a company is entering into a new jurisdiction or a new market. And by virtue of entering into the new market, since it could be, the product could be heavily, competitive, the price point at which the company wants to enter could be well below the market prices. Now, it is a market penetration strategy which has been formalized or thought through by the taxpayer. That does not mean that the prices at which the taxpayer is transferring the goods to its related parties for further distribution in the new jurisdiction are non-arm's length. Now, how do you justify this kind of a arrangement? Because clearly the market price of the product is way below the price to the related party is way below the market price. The recommendation in this case would be that such business projections which have been prepared by the business team are documented, forms part of the local file. A projection of the market, how the group sees that market to evolve and grow, needs to be documented, and such business reports, commercial realities, and backups would form part of a reasonable benchmark. Yes, the numbers have to back the story, but then this becomes a very good starting point in terms of how transactions need to be benchmarked using the sixth method. Another question which we have seen, which we have received is, it says, in case related party transactions are below threshold of disclosure requirement, TP is still applicable. So for the local file and the master file, yes, there are threshold requirements of a 200 million dirham as the turnover for the taxpayer, or 3 point, or being part of a multinational enterprise of 3.15 billion dirhams or more. If your transactions are below that, then you need not maintain that, these two documents. The TP disclosure form guidelines or the thresholds are something which is awaited. It may so happen that the TP disclosure form requirements on the threshold part may still come under, may still be aligned with the local file and the master file, and in that case, the reporting requirements may not happen. However, to your question whether TP will be applicable, our recommendation is, even if today the threshold requirements are not there, taxpayers should eye for ensuring that all their transactions are at arm's length, because you may not be in meeting the threshold today, but let's say in 2 years down the line, the turnover increases, acquisitions happen, businesses change, and then you may be under a transfer pricing regime. So it is recommended that before your tax period, all your internal transfer pricing policies are aligned with the arm's length principle. Can IT infrastructure services being considered as low value adding services? It could. And why there is a area of gray? Because it would really depend upon the nature of support. Now, if let's say the IT team is heavily engaged in development of a new technology, a new platform, it could be a courseware, it could be a new system upgrade, etc., etc. And there is heavy amount of investment which happens, which is very, very crucial for the overall operation of the organization. It may not form part completely, it may not form part of the low value adding service. Yes, there could be a desktop support team which could be there, may form part of the low value adding services, and hence it is very, very important and has been detailed out in the guide that the functional analysis of each department need to be done to say who is doing what and whether that would constitute a low value adding service or not. Another question, and which is an interesting one, which says that, has the reasonable period being defined to determine the long outstanding balances? The answer to that is no. It really depends upon the contractual arrangements between the two parties. All contracts, unless they are done on a PO basis, even if they are done on a PO basis, all invoices or contracts would have a term for payment. It could be 30, 45, 60, 90, 120 days. Typically, our experience has been the authorities are keen to look at similar contractual arrangements with third parties, pick up the reasonable period of outstanding balances from there, and see whether the taxpayers have received the amounts or of outstanding balances from the related parties within that period or not. If not, then they have gone ahead in other jurisdictions on a pro rata adjustment of imputing the notional interest on such outstanding receivables. Another question, is written in the TP guide. There are reporting elements for a TP disclosure form. What is further awaited? One, the threshold is awaited. Two, the TP disclosure form, whether transactions of entities which are part of a tax group, even those transactions, whether they need to be reported in the TP disclosure form or not, is something which is awaited. While we are aware that the transactions between a tax group gets eliminated and no transfer pricing would typically apply, but from a reporting standpoint, would the FTA would want to look at even those transactions is something which is awaited. So we would wait for the form, for the TP disclosure form, to really come up with the compliance requirements. Would a TP memorandum, short form of local file, work if the TP thresholds are not met? Absolutely. It is a very good practice, and I'm happy that taxpayers are looking at these kind of maintaining robust documentation. It could be a common file, printouts of emails kept in a file, kept in an archive, and a short note which details out the transfer pricing policies, how the taxpayer recharges, allocates cost if your transfer pricing thresholds are not met. That is a very good starting point and a very good defense document in case the disclosure requirements are not met. Are there any benchmarking websites being prescribed by the FTA? The answer to that is no, they have not prescribed. They've mentioned that there are external databases which are available. There are many databases and which are available in the region, which give such benchmarks or data points for conducting a benchmarking analysis. So no preferred website list or a database list has been prescribed by the FTA. Who is required to certify the TP report? Would it be statutory auditor or any other qualified CA? So, as the law stands today, there is no requirement to do a certification of the TP report. Globally, we have also not seen that transfer pricing reports or the local files are certified at all by any CPA or a public accountant, and hence it is a document which is to be prepared and maintained by the taxpayer. Consultants can help the taxpayers to really prepare and maintain, but no specific or a formal certification is required for the TP report or the local file. The TP disclosure form, we are yet to receive any clarification from the FTA. I'm just reading through the questions and I'll probably pick up, the last probably one. How to determine the arm's length price for allocation of common expenses like IT services, payroll, etc. Okay. So if there are low value adding services and a taxpayer is providing such services to multiple group entities, then a reasonable allocation key needs to be determined to allocate the common cost to the various subsidiaries, JVs, associates, etc. That could be on the basis of revenue, basis of headcount, etc., whatever the commercial realities of the business warrant for. Once that is done, and if these qualify under low value adding services, then the taxpayer should apply the safe harbor 5% markup, which has been prescribed, and then recharge such cost to the common expenses and allocate those to the respective subsidiaries. If there are activities which are outside the low value adding services, which are strategic in nature, which are more higher value adding, then a separate benchmarking analysis needs to be done for such high end activities, and a separate markup should be charged to the respective companies. It could be CEOs, it could be etc. Again, the guidance has provided that during the course of such support, shareholder activities should not be cross-charged to the group companies, which means MIS consolidations, budgeting, which are pure play activities which are used to make necessary reportings to the shareholders. They need to be excluded while doing this recharge. I think we've shot beyond time. Thank you for your time. Whatever questions have been unanswered, we'll try to answer them once we share the presentation and the recording with all the participants. Thank you. Have a good day.